Most angel investors lose money, not because they picked bad startups, but because they only made 2 or 3 bets. In this video, I'll show you how to avoid the biggest mistake most angels make, not thinking like a portfolio. If you're a founder, your first round of money usually comes from your own pocket, let's be honest, then family, friends, and anyone else you can convince. It's usually at a much later stage that you start talking to VCs, venture capitalists, and more professional investors. The space between your idea, your own resources, and a professional funding roadmap down the line is often bridged by a special type of investor, the angel investor. In this video, we will explore how this world works and how to make yourself attractive to angel investors. If you're a founder or an angel investor, you will hopefully pick up a couple of ideas that I learned in my career that I started in private equity, then moving to family business as a CEO, and now in my journey starting a VC firm. For both prospective angel investors and founders, it is important to be able to put yourself into the other's shoes, understand their viewpoint, what keeps them up at night, and how to make their lives easier. Let's demystify this unique world and take a look behind the scenes of the earliest stages of startups and see how they turn into real companies. Let's get back to what I said about family and friends funding a startup at the very beginning. Technically speaking, these are already angel investors. Anyone who has disposable income and wants to support big ideas can get into angel investing. You can call yourself an angel investor from the first company you back. This is not venture capital. This is individuals making judgment calls on ideas that are pitched to them. In normal angel investing, $25,000 is often the minimum check size accepted. Sometimes you'll see 10K, but often it's like 50K or 100K as the minimum size that excludes a lot of people. Nowadays, there are crowdfunding platforms where you can make investments for much lower amounts. I talked about these angel investing platforms in the past, and they're certainly okay to sort of get your feet wet. Using them can help you improve your processes and teach you some things about the startup world. However, there is an underlying flaw with these platforms. Back in the day when AngelList was launched, which is one of the first of these platforms, and Jason Calacanis did his first investments on the platform, high quality deals found their way on there. But it's almost like this platform struggled from its own success. Suddenly, everyone and their grandmother started posting their seemingly fantastic investment opportunity on there. And this made it overcrowded and means it's difficult to spot the good deals. I would even go one further and say that the good deals don't make it onto these platforms anymore due to that development. These are the public crowdfunding platforms, but there are also some private syndication networks that are becoming more technology driven. I will go into further detail about deal structuring in a later video, but you still need significant funds to get started. Later in this video, I will shed some light on the portfolio construction model. But the first thing I usually hear when discussing these types of deals is, where do you find companies? When you're working in an unrelated field and have little to do with the startup ecosystem, it's easy to overthink how to get deal flow. This is problematic because when you suddenly get that pitch deck in your inbox, your best friend is trying to convince you to invest in his or her business idea. If they do a good job at pitching you, it's easy to think that it's such a unique opportunity that you're never going to see a deal like that ever again. Classic FOMO. Perhaps you go ahead and invest in this one company, and that gives you a taste for it. What's great about this is also the biggest danger. Unlike at a VC where you're investing other people's money, in this case you have no fiduciary duty to anyone but yourself. This means you can do whatever you want, but it also runs the risk of getting out of control if you don't have system and discipline. It's great to be able to do whatever you want. You can choose to support a specific geography, like your local region, or an industry that is close to your heart, like drug research for a specific disease. Ultimately, however, you want this to make a return. Otherwise, you're not going to be an angel investor for very long. But to sustainably do something against this FOMO, you have to make more investments. To understand how this world works on the one hand, and to spread your risk on the other hand. It's helpful here to look at VC from some professionalism. If you're a venture capital fund, you typically invest in 20 to 30 deals per fund. It's very difficult and takes a lot of work and guts to be a high conviction investor and only back a very handful of companies. As an angel, there's a temptation to do just 2 or 3 cool deals that you come across. These are the family friends deals that are sent to you. Statistically, however, that's a recipe for disaster. You're almost guaranteed to lose money that way. You have to learn to play the power law. This means you need at least 10 to 15 angel investments, ideally more like 25 to 40 over time. You spread your bets and give yourself exposure to a potential outlier. Let me explain that. Unlike in a normal distribution where most points are around the average, in a power law distribution, the curve is skewed to the left. It means your winners pay for your losers and then some. Here's roughly what happens in a well-constructed early stage portfolio, so keep this in mind when you do only 2 or 3 investments. 50 to 60% of your deals are a total loss or have less than a 1x return. 30 to 40% will have modest returns, maybe 1x to 3x. And for the remaining 10% or even less, that's where you will hit the real winners. The ones that go to 10x, 50x, or even 100x. That's the power law in action. In most portfolios, one single investment will often return more than the entire rest of the portfolio combined. That's why missing the outlier or not making enough bets to find the one is what kills most angel portfolios. Thinking back to how much money you need to get started, you need to multiply that 25,000, that's the minimum check, by 20 or better 30, which brings you to 500k, 750k as a minimum that you need to allocate to this path of being an angel investor. This is the absolute minimum. Don't forget, you will need capital for follow-on investments. If something starts working, you'll want the firepower to double down, both to be not diluted and also to benefit from being right. So you've decided you want to build a solid angel portfolio. You've got the spreadsheet fired up, possibly already included the first investment that you made with your family friend. But here's the next big question. Where do you actually find good deals? As soon as you start calling yourself an angel investor, messages will start flowing in. Like LinkedIn has become full of these automated spam emails. Random people you meet at a dinner will pitch you their idea. It's literally, as an investor, it comes from everywhere. But the truth is, the best deals don't come to you. You have to be able to withstand the noise and sharpen your senses to spotting the diamond in the rough. With your target set on being an angel investor, with that total allocation in hand, you're holding the honeypot and everyone wants to participate. Still, your personal network will be the first place to look for deals. Startups founded by former colleagues, university contacts, or friends of friends. This is where most new angels make their first investments, and it's actually not a bad thing if you know the people well. Then you can join angel groups and participate in syndicates. These are global communities often of angel investors who share vetted deal flow. But when I say vetted here, I mean this is still just deal flow. You don't have to invest right away. A very solid way to get access to startups is through accelerators and incubators. An example of this is Y Combinator in the US or VentureKick in Switzerland. These showcase batches of promising early stage startups, often with demo days open to angels. Actually, following accelerated demo days is a smart way to find strong startups that already have some validation. This way you can also see founders hustle, you can see them in action in public, which is another great thing to see apart from them just pitching to you directly. Then there are startup events and conferences like Step Dubai, Web Summit, or even small local founder meetups. These can be amazing for sourcing deals. My tip is not to pitch yourself as an investor right away. Just be curious and build relationships. Founders love to talk. Also, you can help another founder, even if you're not invested. I know, what a revolutionary insight. Once you start building a network, you make a few investments here and there and build a reputation as a fair and helpful angel. Founders start sending other founders your way. This is the best form of deal flow because it's already filtered and warm. You want to avoid the cold inbounds, anything random really, and you want to avoid falling into the FOMO trap that I was talking about earlier. Just because everyone is talking about a hot deal doesn't mean it's the right fit for you. Keep a cool head and don't outsource your judgment. Think about your deal flow like you're building a sales pipeline. You want a steady stream of inbound a strong network of referrals, and a clear sense of what you're actually looking for. As you grow and become more established, quality goes up and noise goes down. And that's when it starts to get really interesting. That's another reason why you should start small and slowly work your way up the ranks. But getting deal flow is only half the battle. Now comes the hard part, deciding which companies are actually worth backing. Now let's say you've cracked the code on deal flow. You've got maybe 10, 20 startups landing in your inbox each month. Now what? How do you actually decide which deals to write a check for? Welcome to the real work of angel investing, deal selection. My first filter sounds basic, but it's the most important for me, and it's this: do I understand it? If you don't understand what the startup does, don't invest. This should really be the rule for any investment, but with larger companies, blue chip stocks, ETFs, there is market validation in most cases, but here you're betting on a very small team solving a specific problem in a very specific way. If you can't grasp the business model, you don't know the market or the customer, you can't possibly assess the risk. And how are you going to help them achieve their goals if you don't fully grasp what they're doing? You should only invest in what you understand, period. Once a startup passes this first filter, I use a simple 3-step mental model when evaluating companies. Firstly, the founders. Are they obsessed with the problem? Do they have founder market fit? By that I mean, why are they specifically in the position to solve the problem? Past success helps, but resilience and adaptability matter more. Basically, the team is what brings magic to turn an idea into reality, and that's why it's the first thing that needs to fit. Secondly, I look at the execution probabilities and how likely they are to reach the next level. How is it looking on the product side? What's the go-to-market strategy? What's the value proposition? Are they solving a real problem? Is the market growing or underserved? Do they have any market validation yet? And how likely are they to attract more funding until the money runs out? Thirdly, I think back to the power law and what I need from this in terms of returns. When you're taking these big risks, it's important to take big risks on things that at least have the potential to deliver an outlier return. So I ask, does this company have the potential to be one of my very few outliers? Is there enough there in terms of market, ecosystem, business model? Is the timing right? It's important to switch perspective from understanding the details to taking a view on a meta level. You're taking massive early stage risks, so you need asymmetrical upside. If everything goes right, can this startup 10x or 50x your money? Can it create or dominate a new market? You're not looking for decent businesses, you're looking for outliers. Coming from PE myself, let me just demystify something. This doesn't need to be a formal due diligence. It can be a 20-minute or 1-hour call and a couple of hours of reading. But it's important to have a process and to document everything so that you can go back and look through your decision-making process, look through your notes. So let's say you've written the check. You've backed a great founder. Now what? This is where angel investing gets interesting, because it's not just about putting in money and sitting back. In fact, one of the biggest advantages that angels have over institutional investors is their ability to be personally involved. But what do I mean by that? Especially if you have a full-time job, this can be challenging. Don't worry, you can be as active or as passive as you want. But let's say you want to help. How would you do that? You can bring strategic guidance, you can make introductions, you can help with the hiring, you can boost the morale and motivate, and you can choose to take a more formal role like an advisor or even a board seat. Startups at the angel stage are messy, chaotic, often flying blind. If you've built, operated, or invested before, just sharing your perspective on positioning, pricing, maybe specific IT problems they may have, or even help them say no. Like, you don't have to know everything. You just need to help them ask better questions. Sometimes just being a sounding board makes all the difference. The single most important thing that you can do as an angel is to open doors. Just opening your network to the company may already be super helpful. Customers and investors are obviously the most critical, but even connecting them with a great lawyer can be great for them. Anything that moves the needle. Founders are always looking to hire, but in the early days, they don't have the cash or the credibility to attract top talent. If you can help them refine a job description, recommend someone, or even just post about their hiring needs to your network on LinkedIn. It helps. Founders face rejection, setbacks, imposter syndrome, and cash crunches all the time. Startups are emotionally brutal. If you can be the person who sends a supportive message after a tough day, or remind them why they're the right person to solve this problem, you become part of their inner circle. And founders remember the people who had their back when things got hard. You might want to also formalize your involvement as an advisor or board member. Remember, it's okay to stay in the background, but this is the most involved you would be as an investor. Your role here is to empower the founders. It's their vision. You're just helping them execute faster, hopefully. This ties back to what we were saying earlier about deals. If you prove yourself to be useful, that's how you're going to get into the good deals. We've spoken about the fundamentals of angel investing. You got a first glimpse at the selection process and what the investor mind thinks about. There are many more things that make an investor say no. Red flags that founders raise, often without noticing. It's important to understand these reasons, both as an investor and as a founder, and you can find out more by watching this video here.